So this netting of the capital gains. So we add up all of our capital gains. We've got long-term capital gains, we've got short-term capital gains. We've got long-term capital losses, we've got short-term capital losses. We've got collectibles gains. So we've got all these different categories of capital gains and losses, and what we get to do is combine them all, but we have to combine them in a certain order to determine what the tax is on all of that. So once they've all been calculated, they need to be combined in a certain manner before we apply any of the special tax rates. First thing we're going to do is combine all short-term capital gains and short-term capital losses. So short-term capital gains plus short-term capital losses. That's step one. The next thing we're going to do is combine all long-term capital gains and long-term capital losses. So we would get a result here if we had gains and losses. We'd get a result here if we had gains and losses. So we're going to combine all of those. Then we're going to combine the short-term gain or loss with the long-term gain or loss. All right, so step 3 is we're going to combine step 1 and step 2. If the net result is a short-term capital gain and a long-term capital gain, wait a minute, hold on. Combine all long-term capital gains, net long-term capital, combine the net short-term gain or loss with the net long-term gain or loss. If the netting results in a short-term capital gain and a long-term capital gain, or a short-term capital loss and a long-term capital loss, the netting process ends. So what we'll do is, their wording in this always throws me for a loop. Hold on. So if we get So if this is, how do I do this? So if this one ends up being a gain and this one ends up being a gain, then we will have long-term capital gains at long-term capital gains rates, and we will have short-term capital gains at short-term capital gains rates. So they'll be separated, and there'll be gains at each of those rates. Or if it's, so I did both of those. So then whatever the capital gains rate is, that's what we're going to use. And then we stop. And you'll see on the Schedule D, there's 2 parts of it. The first part is for short-term capital gains. They're going to be taxed at the short-term capital gains rate. So you combine all of them together. And then if you've got a gain in both areas, each of those gains is going to be taxed at whatever its appropriate rate is. If you have a loss, though, some other things happen. So let's see. Short-term capital gain, or short-term capital loss and long-term capital loss. The netting, I don't like how this is worded. Let me pull up. Okay, let's look at this. So the netting process can result in the following outcomes. Net short-term gain and a net long-term gain. Then the short-term gains are taxed at regular tax rates. The long-term gains are taxed at the long-term tax rates. If there's a net short-term gain and a net long-term loss, maybe I didn't do this right. So I don't like this. I don't like this. Sorry. I need to put together some better steps here. So net short-term gain and a net long-term loss. So if it's a gain, then we're just gonna apply it at the long-term capital gain rates. Capital gain. Got G in there twice. This will be short-term capital gain rates. And then we'll stop. If we've got a short-term and a long-term gain. If we have a short-term gain and a long-term loss, the long-term loss is offset against the short-term gain. So we get to offset those two. So so these are the different, maybe I need to put it up as options, but 3, 4. If we have a short-term capital gain and a long-term capital loss, we get to offset against each other. Whatever, so for example, if a short-term capital gain is 100 and the long-term capital loss is 90, we're going to combine those two, and what we get is a $10 short-term capital gain. Okay, so short-term capital gain, long-term capital loss, we get to offset those against each other. If a long-term loss results, the loss up to $3,000 reduces other income and any excess carries forward indefinitely. So a second example here would be, and that's if it's a 300. So if it's say it's a $100 short-term capital gain plus a $4,000, after we've netted them up here, long-term capital loss, we're going to get to take, so in total, it's a $3,900 loss, but we get to take $3,000 this year and carry forward to the next year the other $900. So we're going to combine those. All right, so long-term loss is offset if it's a short-term gain with the netting of those. Short-term gain is taxed using the regular tax rates. So again, this is short-term, so it would be at our regular tax rates. This, we would get to take the loss if it's the other way around. Whoops. If we have a net short-term loss, so here we had a gain, here we had a loss. If we have a short-term capital loss and a long-term capital gain, we're going to separate the long-term gains into its different classifications. So if it's a 25% gain, so it's that, if it's a collectibles gain, then it's going to be taxed at 28%. So if within that we've got collectibles, we're going to tax that at 28%. If we've got one of those 1250 gains, that's going to be taxed at 25%. Or if it's, so loss, gain, we're going to have to separate all of those long-term gains into their separate groups, okay? $15, whoops, 20. So these obviously are one group. And that's going to be dependent upon our other taxable income. Any short-term loss is first offset against the 28% group. So what we're going to do first, we're going to separate into these separate groups. And the first thing that we're going to do is offset any long-term gain against, short-term loss against the 28% group. So we get to reduce the 28% group. Then we'll reduce the 25% group. Again, these are our short, so we're going to apply any of our short-term losses. Well, wait a minute. It says short-term, oh, I said that wrong. No, that's right. Short-term losses, we're going to apply first, separate these, and then we're going to apply our short-term minus our short-term capital loss here. So that'll be our first step. Second step, we're going to take the result and we're going to apply that, take our 25% gain property and subtract it from the remaining short-term capital loss. And then the rest, we're going to apply against our 20, 15, or 0% capital gain property. So we get to first offset the higher tax property. Okay, so this is with a short-term loss, long-term gain. Those long-term gains could be 28%, 25%, or any of these. We're going, or actually these, depending upon the bracket that we're in. That short-term loss is going to offset the 28% group, 25% group. If any loss remains, then this other group of assets. Okay, so what this does is this reduces, like I said, this reduces first our higher tax rate items. Okay, I shouldn't say. So the plus should be an and, not a plus. And. Sorry, I know that's kind of, it looks like a plus. And. Instead of pluses. Last part, if we have a net short-term loss and a net long-term loss, so up here, so short-term loss and long-term capital loss. 3,000 of the loss is deductible. Against other income. So if we had, let's say this was $200 loss of short-term capital loss, and long-term capital loss was, let's say it's $3,000. Then we can deduct $3,000 from other income elsewhere on the tax return. This $200 will get carried forward, and it will retain the same holding period. So it will get carried forward as to the next year as a short-term capital loss. Let's see. Income. Short-term losses are deducted against other income. I said that wrong. So this is, so it wouldn't be the 200 there, but 200 of the long-term. So we're going to carry forward 200 long-term capital loss to the next year. If it were the opposite, like if it were a $3,000 short-term capital loss, well, I guess it would still be long-term. If it were let's say it was a $3,200 capital loss, short-term capital loss, and a $300 capital gain, then we would carry forward 500. Of that 500, 200 would be short-term, 300 would be long-term. Because we can only, we're going to first offset the short-term losses up to $3,000. And then after that, we're going to offset the long-term losses. It's complex. let's see. Excess losses are carried forward next year to the next year, retain their original character. Short-term loss carries over as a short-term loss. Long-term loss carries over as a long-term loss. All right. So let me see if I can. So we've combined those. It's a short-term gain. Combine those. It's a long-term gain, and we're going to use those rates. If we combine the gains and the losses, if we have a long-term loss, then we're going to offset those two. One is a gain and one is a loss. We're going to offset them. If it's a short-term loss and a long-term gain, then the loss is going to offset at these special tax rates first, these higher tax rates first, giving us a tax benefit. If we have a short-term loss and a long-term loss, we're going to first take the short-term loss up to $3,000, and then any remaining loss gets carried forward. If our loss is only long-term, then we're going to take up to $3,000. All right, let's take a look at this. Adrian and Pat sold property in 2024. It resulted in a long-term loss of $8,000. They had no other capital transactions, filed a joint return for 2024. They had taxable income of $5,000. So this is a really easy example because they only have one loss. It's a long-term loss. So they're going to get to take up to $3,000 of that is going to offset other income on their tax return. $5,000 that's remaining is going to carry forward, and it's going to retain its long-term loss carry forward. Okay, in this case. Now, this one's more complicated. Alan Masters has the following capital transactions. So let's look at these individually. Stock 1 held 9 months. He held it for 9 months. Is it short-term or long-term? Hello? He had it for 9 months. Is it short-term or long-term? Short-term, thank you. Stock number 2 was held 4 months. Short-term or long-term? Short-term, right. Stock number 3 held 30 months, right? And then we have a collectibles loss as well. All right, so here's our gain, and I'm out of space here. Maybe I'll put it over on this side. All right, so we have we're going to combine our short-term gains and our short-term gains and our short-term losses, which we just have, what is this? We just have one. So we've got an $18,000 short-term, I'm sorry, no, we have a short-term gains, losses. So in this case, we've got 6,000 minus 8,000. So we have a $2,000 short-term loss. And then we have a $18,000 long-term gain. Right? And then we have a collectibles gain of 6,000. I get that right? It's the sales price 6,000. All right. So let's see if we can figure this out. First thing we're going to do, so that's a loss and that's a gain. So we have a short-term loss and a long-term capital gain. So we're going to separate the capital gains into our separate tax rates. So we have this collectibles gain. We're going to offset our short-term, why did I say GL? CL. Capital loss. We're going to offset our collectibles with that. So we'll take the 2,000. So now we have a $4,000 collectibles gain. And we have an $18,000 long-term capital gain. So we've got this and this. Let's see if we're right. Whoop. Okay, short-term capital loss. And we're assuming, oh, they want the tax. Well, they can do the tax for us. So the short-term loss of 2,000 offsets the 28% gain on the collectibles. So that brings that to 4,000. Result is a long-term capital gain of 18,000 and a $4,000 28% gain. These are if they're in the 15% bracket, I guess we would know that from it. This is a continuation of an example here. So these would be the tax rates. So that 18,000 would be at the 15% tax rate. The 4,000 would be at the 28% tax rate. All right, now, questions? Yeah. How would you know what? The 15% you're going to use if they give you, where is it up here? And I think it's not really in a, so these are the tax rates. So it depends on the other taxable income, what tax rate they're in. So let's see. Single person with taxable income of $47,075 would be 15% for long-term capital gains. Let's see. I thought they gave us, here we go. This is easier to see. So taxable income, so you've got to know what the taxable income is first. If their taxable income is over these amounts, that's at the 20% tax rate. Over here. If taxable income is between these, most people would fall between these. Between these amounts, depending upon filing status, well, maybe not most people, because married filing jointly, that's 94 is pretty high. But if the taxable income falls between those levels, then they're at the 15% tax bracket. The example must have given us their income before, because it's still, I guess it's a continuation of an example. So, sorry, I want to try and get all of this in. So you'd use these brackets to determine. And then if it's below this, or up to this amount, it's a 0% tax rate. Okay, these are in this chapter, and they're also at the back of the book, these tax rates. All right, let's see. Let's do the second part of this. So that's where they get the 15%. Okay, assume similar facts except that stock 3 was sold for $20,000 with a basis of $38,000. Now we've got a loss here. Long-term capital, we have a long-term loss of $18,000. Anything different there? All right, and our collectibles is still $6,000. So this is our scenario here. So now we've got a long-term loss, long-term capital loss, and a short-term capital loss, and a collectibles gain. So short-term capital loss, long-term capital loss. And so now we're going to use this scenario here. We're going to deduct using the highest tax rate first. I think we're going to so we're going to take 3,000. We're going to net the long-term loss against the collectibles gain. So we're going to net that to get a long-term loss of 12,000. So we'll take this and combine these two. to get $12,000 long-term loss. So now we have a $12,000 long-term loss and a $2,000 short-term loss. What we're going to do is in the current year, we're going to take the $2,000 short-term loss and we're going to take $1,000 long-term loss. So there's our $3,000. And we're going to have to carry forward $11,000 long-term loss. So we're going to first offset that against the short-term loss. So we'll combine these two. Because this is, again, that 28% is considered a long-term loss. A long-term loss rate. Our long-term loss rates are 28%, 25%, 20, 15, 0. So that's considered a long-term. We're going to net those long-term all together. So that's why we're doing this part. And then we get to take 3,000 of that, all 2,000 of the short-term, and then 1,000 of the long-term. Questions? Isn't that fun? All right, so this is what it looks like. Here's when you're entering these. There are two forms that we use for the capital gains and losses. The first one that we use is this 8949, sales and dispositions of capital assets. We have to divide out these. There are 6 of potential forms, 6 of these 8949s that we may have to use. We have to use a different one for each type of sale. There are 6 types of sales. There are short-term transactions that are reported on a 1099-B, and the basis was reported to the IRS. The 1099-B is the brokerage statement that is issued to individuals when they have a brokerage account and they've had sales during the year. So if you got a 1099-B and you sold stock and the basis was reported to the IRS, and it says on the form, basis reported, basis not reported. Okay, it says, it will tell you on the form, on the 1099-B, if it was a short-term transaction reported on 1099-B, basis was reported, then you check box A. Every single transaction like that is listed on one of these forms. Then, if it was a short-term transaction reported on 1099-B, but the basis wasn't reported to the IRS, you have another one of these 8949s. Box B is checked, and all of those transactions are listed. Third option is a short-term transaction not reported on a 1099-B. So if you sold a piece of land that you held for less than a year, that piece of land, as a piece of investment property, that piece of land would be a short-term transaction and it would not be reported on a 1099-B. So anything that's not reported on a 1099-B. Now, there are 3 more options, because these were all short-term, long-term. So long-term transactions reported on 1099-B, basis was reported, all those transactions would be on 18949. So you have the potential to have 6 of these forms. Okay? But all of them, whatever box you check, all of the transactions that meet that criteria are listed on that form. So here they show, in our example here, because we had both short-term and long-term, right? So we had the short-term listed here. This, they're saying that both of these transactions were reported on a 1099-B, but those are short-term. The long-term transaction, the $18,000, that's going to be on the separate form. Long-term transactions reported on 1099-B. basis reported. And then we would have a third form because those collectibles would not show up on a 1099-B. So we have a third one, long-term transactions not reported on a 1099-B, collectibles, right here. Okay, so in this case, in our example, there are 3 of these forms. All of that information then transfers to the Schedule D. So it starts on the 8949, and then it gets transferred to the Schedule D, short-term transactions, and it tells you right here, totals for all transactions reported on 8949 with box A checked, next line is box B checked, next line is box C checked. So in our case, it was box A was checked, short term, all of that. So the sum of these, 32,000, 34,000, that's going to get transferred to the Schedule D. And that's where it shows up. And it gets summed up here, net short-term capital gain or loss, right there. And then the next section, part 2, is our long-term capital gains or losses. Those are separated out. Remember, we've got our collectibles. That had box, was that? No, these are our collectibles here, right? 6,000. That had box F checked. This one had box D checked. So that, again, that comes from these forms up here. So there's the box D. Whoops. And there's the box F. So that gets transferred over to the Schedule D. And then all the instructions are followed here. Here we're going to net the long-term capital gain or loss, 24,000 of long-term. Combine lines 7 and 15. So here's our 22,000 because we had $2,000 loss there, $24,000 loss there. If you are required to complete the 28% gain worksheet, enter the amount from line 7 of that worksheet. So there's a separate worksheet for 28% gain property. That's the collectibles, right? So that's that. Now we were able to offset. So this would be on that gain worksheet. On that worksheet, we have offset the short-term capital loss with that collectibles gain. Okay, so that's why it's showing 4,000 here. That's the combining of those two. Again, we're combining, we get to offset that highest rate of 28%. Here's the worksheet. So enter total of all collectibles gains, and then following all the directions here. If Schedule D line 7 is a loss, enter that loss. This is our short-term capital loss here. This is what nets it, those two. So that was from this second example, I think. What is this one? This is the first example where we had the short term, we had one gain and one loss. So there's the 2,000. It's our first, did I erase the first example? I think I did. But this just shows you how it would look a little bit different in certain. So this would be, because I think what changed here? Was it the short term? No, short term didn't change. What changed? Was it the long term? So that's collectibles. What changed? I don't know what changed. 2,000. Oh, it was a loss. Okay, so I'm seeing the same number, but instead of a gain, so this was reversed. So the proceeds there it was a gain in the last time. So the long-term, again, long-term transaction, this was a loss. In this example, the second one was I guess I still have the loss written up there. So how that would show up, again, we got the same short-term loss of 2,000, But this looks different because we've got a loss here. We still have the collectibles gain, but this is now a loss, which means that this nets out to a loss. And in this case, because that loss combines with this gain, now we don't have any 28% collectibles worksheet because we've eliminated that collectibles gain with that capital loss. So those two combine together. So combine these two, then we get to take 3,000 of it, and this is where we get the, 2,000 is short term, 1,000 is long term, and then the rest of the long term will carry forward. All right, fun stuff. Questions? I know.